Hi guys, welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita, Khemka.
And I'm Santosh, Nair.
Well, Santo, it was a pretty range-bound session, except for the fact that we opened in the red, we recouped most of the losses, and we ended around that 19,750 mark. So over the last few sessions, even though once we did conquer that 19,800 mark, but even if global cues have not been supportive, we have kind of managed to stay resilient around that 19,750 mark, which is what happened today as well. Global cues are fairly mixed in the morning, but we managed to recoup the day's losses, and in fact at one point we did manage to come back into the positive zone as well. But resilience in the mid and small cap end of the markets as well. Advanced decline ratio tilted in favor of gainers throughout the day. And among the sectoral movers, you had the likes of metals that did pretty well today. Even PSU banks, for that matter, were among the gainers. On the losing end, you had the entire defensive pack not doing well. Pharma, IT, FMCG, all of them under pressure. Among the Nifty gainers, you had the likes of Hero Motocorp, you had JSW Steel, you had Tata Steel, Coal India, and UPL that has been an underperformer, over the last few, in fact, for quite some time now. But today it was on the gaining end. On the losers end, you had Nestle. Numbers will be coming out on Thursday, and ahead of that, it's the top Nifty loser today. Divi's Lab, IndusInd Bank, TCS, Asian Paints, some of the other movers. But before I toss to you for what you are spotting in the mid cap end of the markets, we are waiting for HDFC Bank numbers. Street is factoring in pressure on the margin front, given the fact that it is the first quarterly numbers that are coming out after the merger. But profit and NII growth are expected to grow at steady 30% on a YOY basis. But Santo, what are your takeaways from today's trading session, and what are the trends you are spotting, both in the mid cap as well as the large cap arena?
Well, clearly the preference at this point seems to be for mid caps and small caps, despite the fact that many fund managers have said that they are not very comfortable with the valuations of small and mid cap companies. But then again, if you look at these companies, Nandita, I'm referring to the small and mid cap companies, the order wins in many cases, especially those from the manufacturing sector, those have been pretty strong. To some extent, it does seem that investors' optimism seem to be justified. But now the question is also about valuation. So, for instance, if you see again today, Bajaj Electricals, Kalpataru projects, NBCC, they've all announced major order wins, and similar has been the case with quite a few companies over the last few sessions. So, the key question here at this point is, Nandita, how much are investors willing to pay? And at this point, it does seem that they're willing to pay quite a bit, which is what explains why second line stocks have been doing quite well. And even if you speak to fund managers, they'll tell you that despite their warnings, money continues to gush into small and mid cap schemes, and because they have no choice really but to go and invest that, they continue to do that. So that again is driving up prices higher.
Right, of course, mid and small caps have been resilient even on days when large caps have, borne the brunt of profit booking. But on that note, Santo, let's take a look at the stocks that are on our radar this afternoon. Starting with Dmart, numbers came out on Saturday, and numbers weren't really all that great, because we saw a 9% drop in profit on a YY basis. I think this is the first profit drop in 12 quarters for Dmart, and revenues, however, have surged 19% or thereabouts. Margins, that was a disappointment, given the fact that both EBITDA margin and gross margin have disappointed for Dmart. There was lesser contribution from its high margin general merchandise and apparels business that came as a dampener. But Jeffries in its report has said that it will retain its hold rating. It has upped its target price from 3,700 to 3,850 or thereabouts. Now, interesting to note that earlier in when the company had come out with its second quarter update, Motilal Oswal had come out with a report where it had said that a revenue per square feet seems to be improving. That means the larger stores have started contributing to revenues. Now, in the morning today, I was talking to Hemang Jani about this particular stock, and he was of the same view that now that larger stores have started participating in or contributing to revenues, the upcoming quarters don't look all that bad. Going forward, you can expect earnings recovery to kick in, because the stock hasn't really done all that well. around that 3,500 to 3,600 mark. It has been stuck over there after hitting 4,000 at one point in time. But now going forward, even though valuations are a little stretched, he believes that this is one stock that should be in your portfolio. And if you see a 5 to 7% kind of correction from current levels, this stock could or should be a part of your portfolio. But there are arguments against the stock as well. Citi has a sell rating on the stock. They believe that the throughput recovery hasn't been all that well. That means capacity utilization isn't really happening at such a great pace, and all the store expansion that has happened, it's happened in smaller cities, non-metro cities, and because of that, it says that the recovery could be a little it could get prolonged, as in the recovery could kick in later than what the street is expecting it to be. But all in all, I think since there has been a recovery in revenue per square feet, even though there is there has been slowdown in consumer discretionary spends, but not we have a festive season coming up, right? So that could help the stock to recover a bit, because consumption per se could recover a bit going forward, as it always happens during festive season.
That is what everybody seems to be expecting right now. But Nandita, again the case with DMart also, and I may sound like a struck record here, is a question of valuation. Now the product mix, which is as you mentioned some time back, that it's general merchandise and apparel, the proportion of that in the overall sales has not really been rising, and which is why the margins have been under pressure. Now this has been the trend for quite some time now, and already the stock is not very cheap at this point in time. So big outperformance, I'm not so sure, Nandita, how much of that would you see at these levels, unless market decides to re-rate the stock in a big way. At the same time, a big fall is also unlikely, and partly there the reasons are technical, I would say, because despite being a stock with a hefty market capitalization, it is still not in the F&O segment. So there's no way people can go short on this stock even if they are bearish, and probably that to some extent would limit the downside.
But Sandra, do you think F&O inclusion could be a precursor for DMart to be actually included in the frontline indices?
Well, we have still not heard whether they will be included. The NSE did make some tweaks to the rules for F&O, but it's still not a given that Avenue Supermart will be part of the F&O list. The first stock on my list is REC Limited. The stock again made a fresh record high today. Now overall sentiment for the power sector has been quite strong for quite some time now, and that explains why these stocks are doing pretty well. Now in the case of REC, the general view among analysts is that yes, it's a good business to be in at this point in time, given the positive outlook on the power sector. But what are the kind of returns that you will be making from here on? That remains the big question. Stock has had a fantastic run. Till about a year back, the stock was quoting at barely about 0.4 times book value. Now that has risen to around 1.4 times book value. So those bullish on the stock say that in the past, that is they're talking about 2010, 2011, they said that stock was quoting at almost 2.5 times book value. So there could still be some more space, headroom for valuations to rise. But at the same time, those analysts who are a little more cautious on the stock point out that back then the growth rate was also pretty high. The loan book was growing at about 20%, and the net profit was also growing at about 25% annually. Now that is no longer the case, because the size of the loan book has become quite large. So you could expect some kind of 10 to 12% growth in the coming years, although which is a decent growth, but it doesn't then justify the kind of high valuations that you are seeing right now. So there is a lot of clearly a lot of demand for the stock. You are seeing it hit new highs, but again the risk reward ratio is what whether it's attractive or not, that remains the big question.
All right, I think all of these stocks have been in flavor for quite some time now, REC, PFC and the likes. But let me also touch upon the second stock on my list today, PayTM, because we have a fresh report from Goldman Sachs coming in. Now Goldman Sachs, as we all know, has been super bullish on PayTM for quite some time, and I think it was the first brokerage to come out with a 4-digit target price for PayTM, and right now it has upped its target price to 1250 rupees from 1200 rupees. Potential upside from Friday's close price 30%. So now Goldman Sachs believes that this company is poised to be the best among the internet, within the internet sector, right? It sees the company turning net income positive by FY25. Remember, the company had turned EBITDA positive 9 months ahead of its guidance. Ever since then, I think Goldman Sachs has turned pretty much positive on this stock, and it also believes that operating metrics have only surprised on the upside from there. It expects, or in fact, it has raised the FY24 to FY26 EBITDA estimate by 2 to 5%. It expects revenues to grow 30% in the second quarter, which is this quarter. I think PayTM is expected to report its earnings this week itself, so we'll have to see on that front. And valuation wise, Goldman Sachs believes that at 37 times FY26 price to earnings, company trades at a 20% and 50% discount to Zomato and Nykaa, which, given the company's growth track record, is it doesn't really justify that, given the company's growth profile. So it believes that the upward momentum will continue when it comes to PayTM, and remember, the stock is already up in excess of 70% this year.
Well, yes, the stock has almost hit a 20-month high, so but still cold comfort for those who had bought the stock during the IPO and are still holding on to it. There's been some positive developments in the stock also, but till such time PayTM becomes a full-fledged NBFC, that's what analysts tracking the stock say, you're not going to see a major booster to its earnings. The growth will be good, clearly, but for the stock to re-rate and hit those levels, the level seen at the time of IPO, that could still be some more time away.
But another thing, even Goldman Sachs has pointed out, is that the regulatory issues that the company is facing, right? PayTM Payments Bank has been banned by RBI, or RBI has paused onboarding of new customers there. So once that regulation issues resolve, I think that will also be the next big catalyst, aside of the fact that it expects the company to turn net income positive from FY25. So these, according to me, would be the two major catalysts for PayTM.
Well, and the last stock on my watch list is MCX. The company again hit a fresh record high. The stock hit a fresh record high in trade today, as trading has begun on the new platform. Now, this is something that the market has been waiting for a long time. Quite a dramatic turnaround from the situation in June, when the stock had collapsed after the licensing agreement with 63 Moons had been extended. Now, in this case, Nandita, very clearly, the market now seems to be pinning its hope on FY25 earnings, because clearly the earnings for FY24 will be a washout, because it's paying a hefty sum to
financial technology,
63 Moons and they had to extend the license compulsory for 2 quarters. So because of which there will be a big blow. But HDFC Securities is one of the big bulls on the stock, and according to HDFC Securities, there's going to be a huge increase in MCX top line because of the surge in options trading, and given that crude, gas are all seeing a lot of action at this time, the prices have been quite volatile. So it's very likely that this could result in higher trading volumes in the option segment. According to HDFC Securities, over the next couple of years, that is between now and FY25, the top line of MCX could grow by about almost 50%, but at the same time, the increase in bottom line would be almost 2.5 times. So that is the big bet that HDFC Securities has on MCX, and probably that is what is also driving the action in the stock at this point in time.
I think there was a bit of a hiccup when we had that SEBI order that asked the company to put in abeyance its shift to the new platform, but of course that has been resolved, and the company in fact did shift to the new software today itself, right? Yes. Well, with that, I think we've come to the end of this, this edition of Closing Bell. We've covered all the 4 stocks that were on our radar this afternoon. But of course, as we speak, HDFC Bank numbers have trickled in. We'll be getting you, a detailed, review or breakdown of the numbers in just a bit. So tune in for that. But for now, it's a goodbye from me and Santosh. Thanks a lot for tuning in.